The financial media is already calling today a healthy pullback, which is exactly what they said the last 3 times before things got significantly worse. The S&P 500 closed down 1.62% today, the Nasdaq dropped 1.98%, and the VIX, the market's fear gauge, jumped 12% to 22.2 in a single session. Those 3 numbers in that combination are not random noise. They tell a specific story about who was selling, why they were selling, and whether this is over. The question is, do you know how to read that story before the next session opens? Let's start with what actually moved today, because the headline index numbers are the least informative data point in this whole picture. The S&P 500, down 1.62%, is a fact. But the distribution of that loss tells you far more than the number itself. This was not a broad, passive de-risking. Sector dispersion today was significant. Technology and consumer discretionary led the decline, while energy and utilities held relatively flat. That pattern is not coincidental. It maps directly onto a rate sensitivity rotation. When real yields rise or credit conditions tighten, long-duration assets, growth stocks with earnings weighted far into the future, reprice faster and harder than dividend-paying defensive names. Now look at the VIX move. A 12% single-session jump to 22.2. Context matters here. The VIX doesn't become structurally concerning until it sustains above 25. But the velocity of today's move, not the level, the velocity, is the signal worth tracking. When the VIX spikes 10% or more in a single session, historically it either resolves within 2 to 3 trading days as a mean reversion event, or it marks the beginning of a volatility regime change where 20 becomes the floor instead of the ceiling. The bond market was also sending a clear message today. The 10-year Treasury yield moved higher in the morning session, meaning bonds did not catch a safe haven bid when equities sold off. That matters enormously. When stocks fall and bonds fall together, it indicates the selling pressure is coming from genuine liquidity reduction, investors raising cash, rather than simple risk-off rotation. Smart money watches that equity-bond correlation as closely as any index level. The actionable read here. The internal structure of today's sell-off skewed toward a liquidity event, not a sentiment correction. Those 2 things require different responses. Markets don't move 1.6% without a trigger, and today's catalyst was a combination of 2 converging forces that have been building pressure for several sessions. First, renewed concern about the Federal Reserve's timeline. Comments from a Fed governor this morning reinforced the view that rate cuts in 2026 remain contingent on inflation data cooperating, and the most recent CPI print, which came in 10 basis points above consensus, gave the hawks exactly the ammunition they needed. Markets had been pricing in 2 cuts before year-end. That expectation got pushed back this morning, and repricing that shift in a single session is inherently violent. Second, credit spreads. High-yield credit spreads, the premium that riskier corporate borrowers pay over Treasuries, widened measurably today. That is significant because the equity market often trails the credit market by days or even weeks. Credit deterioration is the early warning system. When leveraged companies start paying more to borrow, it signals stress in the parts of the economy that equity investors won't see reflected in large cap earnings until next quarter. Today's credit move was not catastrophic. We are not talking about 2008 levels, but a widening of this speed in this interest rate environment warrants attention. Here is what the financial media will not say plainly. A single data point that runs 10 basis points above expectations should not, in a healthy market with clear forward guidance, produce a 1.6% equity sell-off and a 12% VIX spike. The magnitude of the reaction relative to the catalyst is itself data. It suggests the market was already positioned defensively and needed only a small push to trigger a larger move. That kind of fragility, coiled positioning under a calm surface, is what precedes genuine volatility regimes, not what follows them. None of this is a prediction. This is not financial advice. But understanding the architecture of a move is how you avoid being surprised by the next one. This is the section that actually matters for anyone trying to make intelligent decisions in the days ahead. Not panicked ones, not reckless ones, intelligent ones. There are 3 data points to watch between now and the end of next week that will determine whether today was a reset or a warning shot. First, the VIX curve. Specifically the spread between spot VIX and the 1-month VIX futures contract. When spot VIX trades at a significant premium to the futures, called backwardation, it indicates short-term fear that the market expects to resolve. When the curve is flat or inverted across the term structure, it signals that participants are pricing in sustained uncertainty. As of the close today, the curve is in mild backwardation. That's a slightly constructive signal for near-term stabilization, but it can shift quickly. Second, the dollar index. Today, the DXY strengthened slightly, which historically adds headwind to large-cap multinationals and emerging market risk assets simultaneously. If dollar strength accelerates, particularly if we see a move above recent resistance levels, expect another leg of pressure on the same growth-heavy sectors that led today's decline. Third, and most importantly, the 10-year Treasury yield at the next 2 auction dates. The government is running a substantial deficit in 2026, and Treasury supply is not shrinking. If upcoming auctions see weak foreign demand, measured by the indirect bidder percentage, that tells you real money is becoming more selective about holding U.S. duration risk. That is the scenario where this gets materially more complicated. The bear case is not that today's numbers are catastrophic. The bear case is that the structural setup, tight positioning, rate uncertainty, a credit market beginning to wobble, means the margin for error is thin. One more adverse data point lands differently in this environment than it would have 6 months ago. Watch those 3 signals. They will tell you the truth before the headlines do. We opened this video asking whether today's sell-off was a one-day reset or something more structural. The honest answer is the VIX velocity, the bond equity correlation, and the credit spread movement all point to a market that is more fragile than its recent surface implied. That's not doom. It's data. The next video covers exactly what a genuine volatility regime change looks like historically and what the playbook is. Subscribe so you don't miss it.